What if the global economy isn't broken? What if it's working exactly as designed? Every year, governments borrow more. Yes. Every crisis triggers more stimulus. Every recession is solved with new debt. And somehow, the solution to too much debt is always more debt. But here's the part nobody explains. If every country is drowning in debt, if households are drowning in debt, if corporations are drowning in debt, who benefits from a system where debt can never actually disappear? Tonight, we're not just talking about bad policies or greedy politicians. We're retracing the architecture of a financial system that may have been built to expand debt forever. A structure where growth depends on borrowing, stability depends on expansion, and collapse becomes inevitable. To understand where we are, we need to rewind, not decades, but centuries. Part 1: Origins. When money changed its nature, money wasn't always debt. For most of human history, money represented something tangible. Gold, silver, grain, or labor was a medium of exchange, not a liability owed to someone else. But the turning point came when banks discovered something powerful. They didn't need to hold all the money they issued. Lost through early forms of fractional reserve banking. Financial institutions realized they could lend out more claims to money than they actually had in reserves. Most depositors would never withdraw at the same time. The illusion held until it didn't. This innovation created something revolutionary. Money could now be created through lending. That means every new dollar entered circulation as someone's debt. At first, this seemed harmless. It stimulated commerce. It accelerated trade. It funded expansion. But here's the twist. Nobody noticed at the time. If money is created as debt, then to have money in circulation, someone must always owe. No debt. No money. The seeds of the spiral were planted. Part 2: The Rise. Debt becomes the engine of growth. Fast forward to the 20th century. Industrialization explodes. Wars require massive financing. Governments lean heavily on central banks. The gold standard limits expansion, so it's gradually weakened. Then comes the final break. When the global monetary system fully detaches from gold, currency becomes fiat, backed not by physical reserves, but by government decree. This changes everything. Now, central banks can expand the money supply without physical constraints. Government deficits become normalized. Bonds are issued. Central banks buy those bonds. New money enters the system again. As debt growth accelerates, GDP rises, markets boom, consumer credit expands, mortgages become common. Student loans explode, credit cards become normal. Debt isn't a side effect anymore, it's the fuel. Here's the cause and effect chain. Governments spend more than they collect. They issue bonds. Central banks support those bonds. Money supply increases. Asset prices rise. People feel wealthier. They borrow more. The cycle reinforces itself. But exponential debt growth requires exponential economic expansion to sustain it. An exponential growth in a finite world. That's where the tension begins. Part 3: The breaking point. When the machine stalls, every debt-based system has a pressure limit. When borrowing outpaces income growth, cracks appear. We saw this pattern during major financial collapses. Credit expands rapidly. Asset prices inflate. Leverage builds quietly. Then confidence breaks. When borrowers can't repay, defaults rise. Banks panic. Liquidity freezes. Here's the uncomfortable truth. Because money was created through lending, widespread debt defaults don't just hurt borrowers. They shrink the money supply itself. The system seizes. Governments face a terrifying choice. Let the system deflate and endure mass bankruptcies. Or intervene and inject even more debt to stabilize it. Historically, they choose intervention. Interest rates drop. Quantitative easing begins. Trillions are created digitally. Asset prices recover, but notice the pattern. Each crisis ends with more debt than before. The floor rises. The baseline shifts upward. The system survives, but becomes more fragile. The spiral tightens. Part 4: Fallout. The hidden consequences: debt expansion doesn't just affect balance sheets. It reshapes society. When money supply grows rapidly, asset prices often rise faster than wages. Real estate inflates. Stocks soar. Those who own assets benefit disproportionately. Wealth concentration increases. Meanwhile, inflation quietly erodes purchasing power. Savings lose value. Fixed incomes shrink in real terms. The public is told inflation is temporary, or necessary, or healthy. But structurally, inflation performs a function. It reduces the real burden of existing debt. In other words, the system requires controlled currency dilution to survive its own leverage. And this leads to another consequence: dependency. Governments depend on low interest rates to service massive debt loads. Corporations depend on refinancing. Consumers depend on credit access. Raising rates too high threatens collapse. Keeping them too low fuels bubbles. Policy becomes a balancing act on a tightening rope. The system can't easily shrink, must keep expanding. Part 5. Failed Fixes. Why reform keeps stalling over the decades. Reforms are proposed: stricter banking regulations, balanced budget amendments, monetary tightening, debt ceilings. But here's the recurring problem. The entire economic structure, pensions, stock markets, housing markets, government programs, is now calibrated to continuous growth. Sudden austerity triggers recession. Recession reduces tax revenue. Reduced revenue increases deficits. Even attempts to reduce debt often lead to more borrowing. It's not incompetence alone. It's structural dependency. Imagine a bicycle that only stays upright while moving forward. The moment it stops, it falls. Debt-based growth systems operate similarly. That doesn't mean collapse is guaranteed tomorrow. It means stability depends on momentum. Momentum requires continuous expansion. Part 6. Modern Parallels. The pattern repeats. Look at recent decades. Global debt has reached levels that far exceed global GDP growth rates. During crises, central banks deploy unprecedented stimulus measures. Digital money creation becomes routine. Balance sheets expand dramatically. Markets respond instantly to monetary policy hints. Entire asset classes react to interest rate adjustments, measured in fractions of a percent. This reveals something profound. The financial system is now hypersensitive to liquidity, and liquidity is created through borrowing mechanisms. We're witnessing repeated cycles: credit expansion, set inflation, policy tightening, market instability, emergency easing, higher debt plateau. Pattern repeats, each time at a larger scale. And the more it scales, the harder it becomes to reverse without systemic shock. The delayed answer: so who benefits? Earlier we asked, if everyone is in debt, who benefits? The answer isn't a secret villain in a dark room. The primary beneficiary is the system itself, the structure that concentrates financial influence in institutions that control credit creation. When money equals debt, those who issue and manage debt wield disproportionate power. This doesn't require conspiracy. It requires incentives. Governments prefer growth over austerity. Markets prefer stimulus over contraction. Voters prefer prosperity over pain. Everyone chooses the short-term relief, and the spiral continues. 3 clear takeaways. 1. Debt is not an accident. It's structural. Modern money systems are designed around credit expansion. Without borrowing, the system contracts. Understanding this removes the illusion that debt is just mismanagement. It's foundational. 2. Growth is required to prevent collapse. Stagnation becomes dangerous in a debt-dependent system. That's why stimulus appears whenever growth slows. The machine must keep moving. 3. Every intervention raises the baseline. Quote, crises are patched, not eliminated. Debt levels reset higher each time. The system survives but grows more sensitive and complex. The warning: no financial system in history has expanded indefinitely without consequence. That doesn't mean imminent collapse. It means risk compounds over time. The real question isn't when will it crash. It's what happens when expansion is no longer politically, economically, or physically sustainable. Because if growth stalls permanently, the bicycle stops moving, and gravity still exists. Closing thought and call to action: this isn't about fear, it's about awareness. If money equals debt and debt equals dependency, then understanding the system is the first step toward navigating it intelligently. Don't just watch markets. Watch credit growth. Watch interest rates. Watch policy responses to stress. Patterns repeat. If this breakdown challenged your assumptions, share it with someone who still believes debt is just a budgeting problem. And if you want deeper explorations into the hidden mechanics of global finance, Subscribe because the next story connects this debt spiral to the future of digital currencies, and why the next evolution of money may not look like money at all.